All right, let's get into this. Welcome to The Explainer. Today, we're opening the hood on an industry that touches literally every aspect of our lives. It mostly operates behind complex math and massive, opaque balance sheets. We usually just think of insurance as the people we call when we rear end someone or need to fix a leaky roof. But when you look at the underlying financial frameworks, specifically the really rigorous sustainability accounting standards from organizations like the ISSB and SASB, a completely different picture emerges. We're going to look at the insurance industry not just as policy providers, but as a massive macroeconomic engine currently facing some very real existential threats. So here's our quick roadmap for today. 1. The insurance growth engine. 2. The cost of uncertainty. 3. Investing the premiums. 4. Managing systemic market risks. And 5. Incentivizing responsible behavior. Section 1. The insurance growth engine. Let's dive right in and look at how this massive financial ecosystem actually operates and makes its money. To understand the core business model of the insurance industry, you've got to picture a giant scale. On one side, we have the engine, the drivers of growth. The industry grows through the steady, predictable collection of insurance premiums, the revenue they get from underwriting those policies, and the income generated by investing all that capital. But on the exact opposite side, we have the ultimate counterbalance, insurance claim payments. This is the primary cost, and more importantly, it's the absolute greatest source of profit uncertainty. The entire industry is basically a high-stakes balancing act between the steady accumulation of capital to drive growth and the massive, unpredictable cost of paying out those eventual claims. Now, to manage this incredibly delicate balance, they can't exactly just rely on guesswork, right? They rely on rigorous, standardized metrics like the SASB standards. Now, sitting under the International Sustainability Standards Board, these frameworks act as a sort of dashboard. They literally force insurers to track and disclose everything from their exposure to extreme climate events to their overall levels of consumer trust. It's really the only way investors and regulators can understand if an insurer's growth engine is actually prepared for the unknowns of tomorrow. Section 2. The cost of uncertainty. So, what actually triggers those massive claim payouts? Let's look at the biggest wildcards on the ledger. What's really fascinating here is a metric called probable maximum loss, or PML. Under the accounting standards, insurers have to calculate this for their insured products. And this isn't some vague estimate. It forces insurers to put a hard dollar amount on their absolute worst-case nightmare scenario. It's the anticipated value of the largest monetary loss affecting their portfolio from weather-related natural catastrophes. We're talking hurricanes, floods, extreme heat, all based on deep catastrophic modeling. To really wrap their heads around these catastrophic tail risks, the standards require insurers to break their probable maximum loss down across 3 very specific exceedance scenarios. They actually have to calculate the exact financial hit of a 1 in 50-year event, a 1 in 100-year event, and a massive 1 in 250-year event. By mapping out a 2%, a 1%, and a 0.4% likelihood of extreme disasters, analysts can see exactly how extreme weather threatens profits across different locations, both before and after they use reinsurance to cushion the blow. But here's the kicker. Not all disasters are treated equally by actuaries. Monetary losses get split into 2 buckets. First, you have modeled catastrophes. These are your large-scale events like hurricanes and earthquakes that get fed into highly sophisticated mathematical models. But then you have non-modeled catastrophes. These are the smaller-scale, much more erratic events, like localized floods, severe droughts, or sudden tornadoes. Insurers haven't fully analyzed these using those same intensive models. And as climate change accelerates, these unmodeled events often remain terrifyingly unpredictable wildcards for the balance sheet. Section 3. Investing the premiums. Okay, we've talked about the risks. Now let's flip to the other side of the balance sheet and see how they put our accumulated premiums to work. There's a fundamental reality to insurance. They can't just leave your premium payments sitting in a vault, gathering dust. To make sure they have the financial firepower to actually pay for tomorrow's disasters, insurers have to maintain long-term asset-liability parity. They do this by heavily investing the premiums they collect today. In fact, they are some of the most colossal institutional investors on the planet. So how does this play out in their investment strategy? Well, because environmental and social factors directly impact the performance of these massive investments, insurers use a structured approach to integrate ESG data, that's environmental, social, and governance, directly into their asset management. The standards highlight 3 approaches. First is screening, so excluding or targeting specific sectors. Second is sustainability-themed investments, like pouring capital directly into clean energy. And third is full integration, which is systematically weaving material ESG factors right into their traditional financial analysis. And obviously, if an insurer is integrating environmental factors, they have to measure the impact of those investments. Under these standards, insurers are required to measure their absolute gross financed emissions, which means they aren't just calculating the carbon footprint of their own office buildings. They literally must measure the greenhouse gas emissions of the companies and the assets they are financing. This gets broken down by Scope 1, Scope 2, and Scope 3 emissions, which really shows the deep layers of carbon accountability required within their portfolios. Section 4, managing systemic market risks. Now, investing all that premium float brings us to a completely different kind of danger. We really have to ask, what happens when the very assets meant to protect the insurance pool pose a threat to the broader financial system? We aren't talking about weather events anymore. We're talking about the risk of a total market collapse. Pay close attention to this specific regulatory label, systemically important financial institutions. Because of their massive size, their complex interconnectedness, and the fact that they engage in non-traditional activities, like dealing in credit default swaps, some insurers are highly vulnerable to market shocks. Basically, if they fail, they could take the entire economy down with them. Because of that, entities with this designation face intense regulatory oversight, with strict limits on their risk-based capital and liquidity. To prove they won't trigger a cascading meltdown, these massive institutions have to show their homework. They must rigorously report their exposure to derivative instruments. The accounting standards make them detail their total exposure to centrally and non-centrally cleared derivatives, plus the total fair value of the collateral they've posted. It's essentially a high-stakes transparency exercise to ensure they have enough liquidity to survive sudden market crashes without needing a government bailout. Section 5, incentivizing responsible behavior. Now that we've seen the sheer, terrifying scale of the risks they face, let's explore how the industry proactively tries to build a safer world. Because insurers desperately want to limit their claim payouts, they're in this incredibly unique position to generate positive social externalities. By leveraging their pricing power, they quite literally pay people and businesses to be healthier and more sustainable. We're talking premium discounts for constructing green buildings, lower rates for safe driving, adjusted premiums for low-emission vehicles, and even life insurance discounts for hitting the gym and eating well. It is literal behavior modification driven entirely by the bottom line. And beyond just individual behavior, they are actively underwriting the green transition itself. The SASB standards require insurers to disclose net premiums written specifically for energy efficiency and low-carbon tech. This means providing specialized renewable energy insurance, underwriting carbon capture projects, and issuing warranties for energy savings. They are absorbing the massive environmental risks that allow these sustainability projects to actually get off the ground in the first place. For this entire incentive engine to work, though, policyholders need to actually understand what they are buying, right? Which brings us to the ethics of how these policies are sold. Unclear policies, hidden terms, misleading sales tactics, these don't just hurt a brand's reputation. They lead to catastrophic legal disputes. Regulators watch this stuff like hawks. They track exact transparency metrics, measuring the total monetary losses an insurer suffers from false advertising lawsuits. They track the complaints to claims ratio to see how many people felt cheated when they try to collect. And they monitor customer retention rates. In this industry, transparency isn't just a nice to have. It's heavily audited. Ultimately, taking on risk isn't just a clever way to make money. As the standards outline, the transfer, pooling, and sharing of risk is the literal bedrock that allows modern society to operate, build, and innovate without the constant, paralyzing fear of total financial ruin. Which leaves us with this final, kind of provocative thought. We've seen the dashboard now. We know how they model extreme weather, how they track their massive investments, and how they report their market exposure. But as global catastrophes get bigger and more frequent, and as global markets get more and more tightly connected, you really have to ask, are the metrics we've explored today enough? Is the insurance industry accurately pricing in its own survival for when the next unprecedented shock hits? It's definitely a question every investor, and honestly every policyholder, needs to be asking. Thanks so much for joining us for this explainer.